October 2nd, 2025. That's the date I want you to remember. That's the day silver spot started trading above futures prices. In any normal market, arbitrage should close that gap in 48 hours, maybe 72 at most. Traders buy cheap futures, demand delivery, sell at spot, easy money, the spread disappears. It's been over 2 months now, every single trading day. And if you understand what that signal means, you need to hear what I'm about to tell you. I've studied commodity markets for years. I've seen backwardation come and go, brief spikes, technical glitches. Nothing to worry about, but this is different. I'm not a financial advisor, this isn't investment advice, but this is a pattern that has appeared exactly 3 times in the last 25 years in other metals. And every single time, what followed wasn't a rally, it was an explosion. Let me show you what the market is screaming right now, and why almost nobody is listening. First, I need to explain something that 99% of investors don't understand. In commodity markets, there's a normal price structure called contango. Futures prices trade above spot prices, makes perfect sense. When you buy a futures contract for delivery in March, you're paying someone else to store that metal, insure it, finance it. Storage costs money. That cost gets built into futures prices. Contango is healthy, expected, the way markets should work. But right now in silver, the opposite is happening. People are paying more to get silver today than they're willing to pay for silver for months from now. That's called backwardation, and it tells you something very specific. Buyers don't trust future delivery. They want physical metal in their hands right now. Think about what that implies. If futures are cheaper than spot, any trader should buy futures, wait for delivery, and sell at spot for instant profit, free money, basic arbitrage. But that arbitrage isn't closing the gap. Why? There's only one explanation that makes sense. There isn't enough physical metal to deliver. Traders know it, the market knows it. That's why they're repaying a premium for metal today instead of trusting a promise for metal tomorrow. Now let me show you what happened the last 3 times this pattern appeared. Not in silver, in other metals, the pattern was identical. The outcome was devastating. Palladium, late 2000. Russia controlled 60% of global palladium supply. Throughout the year, everything looked completely normal. Futures above spot, contango, business as usual. Analysts were calm, then Russian shipments mysteriously stopped. Bureaucratic delays, they said. Temporary, they said. Backwardation appeared, spot above futures. The signal nobody wanted to acknowledge. Within 6 months, palladium went from $400 to over $1,100 per ounce. But here's what most people never heard about. Physical palladium was trading at $1,300, sometimes $1,500. Desperate industrial buyers were paying whatever it took to get real metal. The futures price said one thing. Physical reality said another. Ford Motor Company panicked. Their purchasing department stockpiled palladium at peak prices without hedging their exposure. When Russia eventually resumed exports and prices crashed, Ford wrote off $1 billion in losses. $1 billion, on one metal. The backwardation signal gave traders months of warning. Most of them ignored it. Ford certainly did. Nickel, early 2007, Chinese stainless steel demand was surging. LME inventories quietly declining. No alarm bells yet. Then spot started trading above futures. Persistent backwardation, the same signal. Nickel went from $24,000 per ton in January to $54,200 by May. That's 125% in for months. But once again, the physical market told a different story. Industrial users were paying premiums well above exchange prices just to secure supply. Paper traders got destroyed trying to deliver metal that existed on screens but not in warehouses. Rhodium, 2007 into 2008. South African power cuts shut down platinum group metal mines for 5 days. Rhodium supply vanished overnight. Backwardation appeared as the market scrambled for physical metal. Rhodium went from around $1,000 to $10,025 per ounce. A tenfold increase, 1,000%. Then the financial crisis hit, automotive demand collapsed, and rhodium crashed 90% within months. But for those holding physical metal before the spike, life-changing gains. 3 different metals. Same pattern, same warning signal, same devastating outcome for those who dismissed it. Now let me show you what's happening in silver. Right now, not theory, not speculation, verifiable data. December 2025, first 4 trading days of the month. Over 47 million ounces of registered COMEX silver were claimed for physical delivery. That's not a typo. More than 60% of total registered inventory. Claimed in for trading sessions, industry analysts are calling it a vault drain emergency. I've never seen that phrase used before, but it gets worse. Go look at Shanghai spot prices versus London. Right now, Shanghai is paying $8 more per ounce than London for the exact same silver. $8 per ounce. That's the widest premium ever recorded between these two markets. That's not normal arbitrage friction. That's not shipping costs. That's a market screaming at the top of its lungs that physical metal isn't where it needs to be. In October, silver lease rates spiked to 200% annualized overnight. Think about that number, 200%. When it costs that much to borrow silver, the message is unmistakable. There is almost nothing available to borrow. The cupboard is nearly empty, and here's something that stopped me cold when I first read it. Last month, Korean banks didn't delay silver bar sales. They didn't ration them. They stopped entirely. KB Kookmin Bank, Shinhan Bank, Woori Bank, and H-Nongyup Bank, 4 of the largest banks in Asia's 4th largest economy, told their customers, "We have no silver to sell you. Come back later." We don't know when. When was the last time a major bank ran out of a product to sell? When was the last time they had to tell customers there's nothing left on the shelf? This isn't happening in some obscure emerging market. This is South Korea, Samsung's home country. One of the most sophisticated financial systems on Earth. But there's one more piece to this puzzle. And it changes everything. January 1st, 2026. That's 5 days away as I record this. China is implementing new export controls on refined silver. Not a complete ban, something potentially more disruptive. A licensing system. Starting January 1st, only 44 companies will be authorized to export silver from China. Each one must prove annual production capacity of at least 80 tons. That single requirement eliminates hundreds of small and mid-sized exporters overnight. Here's why that matters. China controls somewhere between 60 and 70% of global refined silver supply. They're not stopping exports entirely. They're turning the tap from open to barely dripping. Sound familiar? This is the exact playbook China used with rare earth elements. The exact playbook they used with antimony and tungsten. Gradual restriction, export licensing, strategic leverage. State media in China is calling this the formal elevation of silver from ordinary commodity to strategic material. That's not my interpretation, that's their words. Silver now sits on the same regulatory footing as rare earths. Ask anyone who trades rare earths what that phrase means. Ask them what happened to prices. Ask them about supply security. I want to be crystal clear about what I'm not saying. I'm not predicting silver will hit $100 or $200 or any specific number. I'm not claiming the paper market will collapse next week or next month. I'm not telling you to buy silver. That's not my job. That's not advice I'm qualified to give. What I am saying is this. Every single signal that preceded major price explosions in palladium, nickel, and rhodium is now present in silver. Persistent backwardation lasting months, not days. Physical premiums exploding between major markets. Exchange inventories draining at unprecedented rates. Banks running out of metal to sell. Supply chains fracturing along geopolitical lines. And here's what makes silver different from those other metals. Silver isn't just industrial, it's also monetary. It's in solar panels, electric vehicles, electronics, medical devices, 5G infrastructure, and data centers. Industrial demand isn't slowing, it's structurally accelerating. Meanwhile, 75% of silver production comes as byproduct from copper, zinc, and lead mining. You can't just decide to produce more silver. You'd need to dramatically increase base metal mining first. That takes years, billions in capital, permits, infrastructure. Silver supply is structurally inelastic, demand is structurally rising. And China just tightened the export valve. Here's what I'm watching. You can watch the same things, all public data. COMEX registered inventories. They started December around 113 million ounces, they've been draining fast. If they drop below 50 million at current rates, the exchange faces a choice. Suspend physical delivery entirely, or let prices find real equilibrium. Neither option is pretty. Shanghai premiums. If they stay persistently above $5 to $8 per ounce over London, it confirms the east-west supply fracture is structural, not temporary. Not fixable with simple arbitrage. Lease rates. When sustained above 10%, that's acute physical shortage territory. October's 200% spike was a warning shot. China export data. First quarter 2026 will reveal whether the licensing system is a speed bump or a concrete wall. You don't need to trust me. CME publishes warehouse reports daily. LBMA publishes monthly. China customs data is public. Verify everything yourself. 2 months of continuous backwardation. That's not normal. That's not supposed to happen. $8 Shanghai premium. Record-breaking divergence between world's two largest markets. 60% of COMEX registered silver claimed in for days. Unprecedented. Korean banks telling customers they have no silver. In 2025, in a G20 economy, China licensing exports to 44 companies starting in 5 days. You can call these unrelated anomalies, market noise, technical glitches, or you can recognize a pattern. I don't know exactly what happens next. Neither does anyone else claiming otherwise, but I know what this pattern looks like. I know what it meant for palladium, nickel, and rhodium traders who dismissed it. And I know which side of that trade I'd rather be on. The question isn't whether I'm right. The question is, are you paying attention? This content is for informational and educational purposes only. It does not constitute investment advice or a recommendation to buy or sell any security, commodity, or financial instrument. Historical patterns do not guarantee future results. Backwardation can resolve without significant price movements. Commodity markets are highly volatile and unpredictable. The creator is not a registered investment advisor. No fiduciary relationship is created. Investing involves substantial risk, including potential loss of principal. Consult qualified financial professionals before making any investment decisions.